Well, today we're diving into a topic that affects almost every digital payment that you make, and it's called the merchant discount rate or MDR. It may sound technical, but don't worry, we're going to break it down in the simplest possible way. So let's start with the basics. MDR is the fee that merchants pay to banks or to payment service providers every time a customer pays using a debit card, a credit card, or even UPI. Now think of it as a small charge that merchants have to pay to ensure that digital payments are fast, they're safe, and they're reliable. Now for this video, there is a disclaimer. We're going to talk about how MDR can work for UPI transactions, but keep in mind right now, there is zero MDR on UPI payments in India, and that's because the government made it free to promote digital payments in the country. So where does this MDR fee go? Well, it's typically shared among three players in the payment transaction. First, there is the issuer bank, and this is the bank that has issued your card or UPI account. So for instance, if you're paying with an HDFC card, HDFC Bank is the issuer bank, and they get a part of the fee to handle costs like managing your account and processing the payment. Next up is the acquirer bank or payment processor. Now this is the bank or the service that helps merchants accept payments from you. So for instance, if your local grocery store has an Axis Bank or Paytm QR code or a swipe machine, that's the acquirer bank or payment processor. And finally, we have the payment network or network provider, and these are companies like your Visa, MasterCard, RuPay, or NPCI, which runs UPI. They make sure that your payment moves from your bank to the merchant's bank quickly, and it does so securely. Now let's make it even clearer with a very quick example. Imagine you buy something for 1,000 rupees and there's an MDR of 2% or about 20 rupees. So that means the merchant has to pay that fee of 2%, which is 20 rupees on the transaction. Now this 20 rupees gets split up where the issuer bank takes 1% typically, which is about 10 rupees. The acquirer bank or the payment processor gets 0.8%, which is 8 rupees, and the payment network, which is your Visa or MasterCard or NPCI, could get 0.2%, which is 2 rupees. So after paying the MDR fee of 20 rupees, the merchant actually receives 980 rupees instead of the full 1,000 rupees. Now to avoid paying this fee is why sometimes you may hear your local Kirana store guy ask you for cash payments instead of cards. Now how does this MDR work for card payments and UPI payments in India currently? For card payments, MDR usually ranges from 0.8 or 0.9% all the way up to 2%. Credit cards often have a higher MDR, while RuPay debit cards have zero MDR, and this again is part of the government's push to encourage more and more people to use RuPay. For UPI payments since January of 2020, the MDR, like I said earlier, has been zero. Now the government did this to make digital payments more popular and accessible, and instead of MDR, what the government does is it offers a 0.15% incentive for payments below 2,000 rupees, and this incentive is shared among banks, payment providers, and your applications like Google Pay, PhonePe, and Paytm. But here's where things get interesting. Maintaining this large UPI ecosystem is quite expensive. The industry, in fact, estimates it costs around 10,000 crores per year. But this year's budget, for instance, allocated just 1,500 crore rupees to support the UPI. So to make UPI more sustainable, the industry has made a proposal to the government and to the regulators. It is said, we can introduce an MDR on RuPay debit cards for all merchants and 0.3% MDR on UPI transactions for large merchants, which are described as those with a turnover of more than 20 lakh rupees. Now, small merchants who have a turnover of under 20 lakh rupees will continue to have zero MDR, which is important because 90% of India's 6 crore merchants fall into this small merchant category. Only 50 lakh merchants will qualify as large enterprises and potentially have to pay MDR if the proposal is approved. So who really stands to benefit if MDR is indeed introduced for UPI? Well, banks, both issuer and acquirer, are going to gain revenue from all UPI transactions. Payment service providers like your Paytm and PhonePe, they're also going to earn from facilitating the payments. And then, of course, NPCI, which runs the UPI network, will secure funds to maintain and enhance the UPI infrastructure. Now, how does all of this affect you and me? Well, if the MDR is introduced on UPI, don't worry. Small merchants will still stay MDR free to keep digital payments easy and accessible. But for large merchants, they might absorb the cost or pass it on to customers. And if they do pass on the cost, you and I could see slightly higher prices for the things we buy from large merchants using UPI, but that increase is likely to be minimum. However, for transactions up to 2,000 rupees, the government's incentive scheme is going to ensure that all UPI transactions remain free for users. So that's MDR in a nutshell. It's a tiny fee with a big impact on digital payments in India. What do you think? Should large merchants pay MDR on UPI transactions, or should status quo continue? And if zero MDR continues, will it affect the growth of the payment ecosystem? Let us know in the comments, and don't forget to like and subscribe for more insights on finance and payment.
For more news and updates, all you need to do is follow CNBC-TV18 on all of our digital platforms.